All good. Thank you very much. Let's get the show on the road. All right. So indexes, superlative. Every 1.5, 1.6, 2% on the NASDAQ, 1.8. But you always got to zoom back and see what's really happening. Still looks good. Zoom back to the days. All right. Well, the Russell's bad. That's where my eye was. So, honestly, you always care about the S&P more than anything else. And the S&P has just, I'd say it's about 50% recovered. We fell from 6150 back to 5850. That's 300. And therefore, 6,000 is the recovery point. So we're just about halfway back on a bounce. And halfway back is, of course, more than 40%. So the weak bounce is 20%. The strong bounce is 40%. So we're right between the strong bounce. Well, we're not there yet, but 6,000 is right between the strong bounce and the weak retrace. Once you get over 60% recovery, then you're over the strong retrace line from the top, and you can say you're back in the same rally mode. All right, so and those are just quick numbers on the short-term bounces. So once you know that, see, that's the thing. Once you know that, then you can quickly eyeball and say, well, these guys in NASDAQ, no success here on the NASDAQ. And if I want to do quick numbers on the NASDAQ, I would call that 21 to 22.5 is what? Is 1,500 points. Therefore, every 300 points would be a bounce. So the weak bounce would be 21.3, weak bounce. And the strong bounce is 21.6. So the NASDAQ is still in the weak bounce line off of here. So what does it mean if you're between the weak bounce and the bottom that you just made? Well, it means you're consolidating for a move down, not a move up, right? And the Russell, of course, has failed very badly. So the Russell is nowhere close. I can tell without even looking, the Russell is nowhere close to a weak bounce. And the Dow, 45 to 42 is 3,000, therefore 600 points. So weak bounce 42.6, strong bounce 43.2. So the Dow has made a strong bounce. All right, so we got the Dow with a strong bounce, the S&P with a strong bounce, the NASDAQ at the weak bounce line, 21.3 is a weak bounce, and the Russell is really consolidating on, I would call 22.50 the right line and say the Russell is just consolidating for a move lower. If the Russell breaks lower, all these guys are probably going to follow it. So, fortunately, we aren't getting small cap reports right now. We're getting bank reports and NASDAQ reports. So those are our early reports. They're going to be hopefully in the positive side. But really good earnings are already expected from the banks. So even the ones that just reported are not that exciting. Let's see if Citibank is holding. So, keep that in mind. So you see, 600 points. Here's the sad thing. 600 points up in the Dow is not even getting us near the where we were. So it's really nothing to get excited about. It seems exciting. You look at today and you're like, oh my God, we're up about 1.5%, 1.6%, 2%, but 2% is only a weak bounce on the NASDAQ. You can't get excited, okay? Like it's like if the patient's on the operating table and they're dying and their heart goes beep, 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 and you give them a shock and their heart goes beep, 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 then it goes back to going beep, 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 beep. It didn't do anything. That's where we are now. There's like shocks being given to the market, and we are just, as I pointed out this morning, we are just, it's Wednesday. We are Thursday, Friday, and Monday at noon. So we are 3 market days away. Oh, I'm sorry, not 3 market days, because we closed on Monday, the markets. So we're 2 market days away from Trump being president, and who the hell knows what's going to happen in his first day or two. He wants to completely reverse. This isn't anti-Trump. I'd be anti anybody who's doing that. You don't do drastic reversals of US policy immediately upon taking office. It makes this country look unstable. It makes our promises look meaningless to other people. I'm going to take apart NATO. Well, you already tried that the last time. I'm going to take apart NATO. I'm going to take over Greenland. I'm going to make Canada a state. And you can say, oh, it's all bullshit. Well, that's helpful too, right? Having a leader who says things that nobody pays, they turn out to be complete bullshit. That's also not very good when you're trying to establish yourself as a world power. And yeah, of course, we are a world power. We have established ourselves, but there's building a reputation and there's destroying a reputation. So, today we've got a ceasefire in the Gaza. That's very good. People have got to be happy about that. You would think oil would be trending down, but it's not so far. Look at oil, 79.50. We just shorted it in chat. I just said to the members, I don't remember what I said, but I said something. I said something. Hopefully it was useful. I forgot. I wrote T-5 for Trump, and it is T-5 days, but that is not really the point. Why is it not going away? Okay. Let's see. What did I say about oil? So, that was in the, here it was. When the petroleum status report came out at 10:30, we didn't look at it till 11, but this is the thing that happened. See, the headline crude inventory is down 2 million barrels. This is really large type. Make that a little bit smaller. Okay. So when the petroleum status report came out, we were minus 2 million barrels. And the last 2 weeks, we've had massive draws. Now, the reality, though, is the gasoline inventory is up 5.9 million barrels, and distillates were up 3.1 million barrels. So net, that's 8, 9. So that's 9 minus 2 is 7. So we have a net 7 million barrel overall build. That's crazy. 7 million barrels is a huge amount of oil. It means every day 1 million barrels of oil are building up for the week. And that's coming off of several weeks of massive builds. So, well, we can look at the, is it 1 o'clock already? Yeah, it's 1 o'clock. We should be able to look at the full report. So hang on, let's take a look. Petrol. They call it petrol in Europe, Petroleum status report. PDF. Yikes. And now this needs beginning. What's that word from Trump? Oh, bigly. Yeah, he used to say bigly. And that's what they used to make fun of, that he said bigly. All right, so same narrative. It's the right date. January 10th, 2 million, 5.9, and 3.1 equals da 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 da. Okay, great. So, what is the reality? The reality, let's keep in mind, we're remember when we used to export 4 million barrels a day, and I said that was insane. Now we're exporting 5.2 million barrels of oil per day. There are 7 days in a week. So 5.2 times 7, 36.4 million barrels of oil we're exporting. We only consume, well, we don't consume, that's the thing. The US looks like it consumes 20 million barrels a day because that's what we produce as far as petroleum products. But the reality is we're exporting 2 days, 2 out of 7. I don't know what 2 out of 7 is, but it's a lot. 2 divided by 7 is 28%. So 28%, this is getting close to one, well, it's over a quarter, it's getting towards a third, but 28% of all the fuel that the US supposedly consumes, and we are the world's largest consumer of oil, and let's put consumer into air quotes. So 28% of the oil that the US supposedly consumes is being exported to other countries. We're not consuming it, we are refining it for other people. That needs to, so you know, and then when they point to the US, say here's how much oil you're using, and here's how much energy you're using, your per capita consumption, it's exaggerated by 30%. All these statistics you hear are exaggerated. And when Trump says drill, baby, drill, drill what? So we can export more? We have much more oil than we need. We have 30% more oil than we need already. What does drill, baby, drill do for you if you already have 30% more than you actually use? That's kind of kooky, isn't it? And how much oil do we import? We import 2.8 million barrels per day, and we export 5.2 million barrels per day. So that's 2.4 million barrels per day domestically more than we need. That's why his policy is idiotic. And again, I'm very, very conscious now of the, what do you call it, the mega police. we all have to be in fear of the mega police now. So I'm not saying anything bad about the great President Trump. I'm only saying that his policy is asinine and makes no sense and has no benefit and will only lead to disaster. Because if we do have a recession and we're drilling 5 million barrels a day more than we need, then shutting down those additional capacity will be catastrophic for the energy industry. If Trump does want to do something, he can fire up the Strategic Petroleum Reserve and buy a lot more oil. If he bought, for example, 200 million more barrels of oil, that would be buying 10 million barrels a week, or not let's say 7 million barrels a week of oil. And that would then we'd have a reason. So in other words, for a year until we fill the Strategic Petroleum Reserve would be bursting at the seams if we had 6 million barrels, but at least there's a strategic concept to that, where if he encouraged this and took these 5 million barrels and said, instead of shipping them overseas, why don't we put these extra barrels into the Strategic Petroleum Reserve? You know why not though? Because these barrels have been refined. There's a big profit between putting them in the reserve and selling them for a huge profit when you refine them. But notice our production hasn't changed at all. We still produce the same amount of motor gasoline as last year. We produce the same amount of distillates as we do last year, a teeny bit more, and we produce a little bit less of other stuff. So the mix is all the same. We went from 19.9 to 20.2 in production. So very little additional product supplied, but quite a bit more product exported. And of course, we're paying the same price, basically. Everything's about the same price as it was last year. Except the barrel cost is more. So who's making the money? If everything is the same price here, and our barrel cost is more, who's making the money? Well, the refiners. They're paying 72. I'm sorry, not the refiners. The refiners are making less because they're paying $5 more a barrel and selling it for the same price. Why? Because there's no real demand here. The demand is in other countries. There's no growth of demand in America at all. Obviously not, because we're exporting 500,000 barrels a day more, and we have more, look here, more total oil. We're exporting 500,000 barrels a day more than last year. Oh, I'm sorry, 600,000. So we're exporting 600,000 barrels a day more per day than last year. So that's 600,000. Whoops. 600,000 barrels times 365 days, We're exporting 219 million barrels of oil more, not total. That's how much more oil we are exporting than we did last year. Yet, don't forget this is for a year. Our total oil reserves in the United States went from 1.69 billion to 1.625 billion. We still, even though we exported 219 million barrels of oil, so this should have been 1.8 something, 1.84. So had we not exported this extra 219 million, not had we not exported 5 million a day, which would have been a billion more, and we don't have capacity for that, but had we not exported an extra 600,000 a day, we would have had 200 million more stuck in the, let's say, in the strategic reserve. That's full. 600 million barrels is full for the strategic petroleum reserve. That's how bullshit all these figures and things that they tell you are. It's not real at all. And I used to yell at reporters about this all the time because they would call me when I was up in New York. I used to be like more in the media, and they would call me and they would ask me about oil prices and things like that because I'm supposedly an expert on these things, and I would start talking about this stuff. And the problem is it doesn't fit into a soundbite. And I'd be like, why don't you report on this? And they're like, we would have to do a whole hour-long show to lay it out and blah 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 and this and that. And they just want the quick answer as to why oil's going up. And I'm like, that's just so insane. You know, it's like it's the same, but we do the same thing with everything if you think about it, right? It's like what causes heart attacks? Oh, if you eat this, you get a heart attack. If you don't do this, you get a heart attack. Not the whole complex interactive ecosystem of your body and your exercise and your environment and so on and so forth. No, we can't talk about that because that would require somebody paying attention for more than 10 seconds. So we need one thing. And everything, and pay attention to this when you're consuming media. You know, when you're using your phone and consuming media, and even on TV, you know, pay attention to how many things they drive down to like a single bullet point, not even multiple bullet points. One bullet point is basically the max attention span they think you have. And every single thing is down to a soundbite now, and nobody wants to hear any kind of explanations, background, so on and so forth. I don't even know why you guys are here, frankly. I mean, according to market research, you don't understand anything I'm saying. So, you know, I tend to believe people can absorb information, but you know, basically you're told not to all the time. And I've been told, believe me, by my own marketing people tell me you make things too complicated or you talk about too many things and people can't focus, because you know what? We get complaint letters all the time from people who say, I don't understand what he's saying. I don't get it. I don't know. It's too many things. Can you just tell me what to trade? And I did. We started this conversation with me saying short oil at 79.50. I did tell you what to trade. Now I'm telling you why. And I realize this is a problem. I wrote about this in the top trade report. I realize this is a problem because the people who do understand what I'm saying and do like a more complex format and want to understand the mechanics of what they're doing, they don't write letters to the marketing department saying Phil's doing great or thanks for this or give me more of that. They don't do that. They just take the information and go. It's the people who don't understand that write the letters. And then my marketing people who also don't understand what the hell I'm talking about, those people they come back to me and say, Phil, you're being, you know, why do you spend 20 minutes of your webinar talking about the micro analysis of the oil report? Because people don't like that. And when they say people don't like that, they mean two people wrote in a letter complaining that they spent 20 minutes listening to the micro analysis of the oil report, when all they really wanted to hear me say was short oil at 79.50 and move on. Right? That's all we did. Boom. See, that's where we started. So anyway, it's driving me crazy. I guess it's because we had a lot of meetings at the end of the year. We had a lot of meetings. We went over stuff, and some of these things are just really getting under my skin. All right. So love you too, Maddie. All right, let's see. So what else is going on? Natural gas punching up to 404. We talked about going long on that last week. Let's see, where's oil now? I mean, you see, you get into it and then you like check it every 10 seconds. 79.55. Going the wrong way. I do have a lot of confidence in that, but natural gas is over 4. This can squeeze up to 5 very fast. If anything happens, we can see a pretty fast squeeze up to 5. What was this webinar supposed to be about? Does anyone remember? It's still too big, isn't it? Control minus. One more. You guys can read that. So what were we supposed to talk about today? Portfolios and the Beige book. So I better get on track. The Beige book is coming in 40 minutes. We did have some good discussions today, so we really should talk about that, though. Well, time management is hard. Okay. Talked about things today. What was this chart? Oh, we were talking about Paul Volcker, and I had Bodhi do a timeline. I hope that's clear. It's like I don't like to constantly, and here's Bodhi, but I mean that's Bodhi, and he's in. I always put the bots in purple if I can. Volcker's battle against stagflation, blah blah blah. So he did a little timeline for me while I was talking about it, because I don't know. I see in my mind, I say like I know this, you know. So I could teach this at Harvard, but I know all about this stuff, so it's nothing to me. But then I say it, and I say, oh, I wonder if people don't know about that. So I told Bodhi, I said, could you please summarize the timeline and history of Volcker's actions in the 70s? And he goes, boom, boom, boom. And actually, I was wrong. It turned out to be the very late 70s, 80s. I was thinking it was a little bit, I thought it started a little earlier. So I guess I couldn't teach at Harvard if I can't get the years right. But anyway, I thought that was very useful. And then I made a chart to show what happens. And oddly enough, you know, when Volcker starts tightening in 79 to 80, the reaction was pretty bad. We got a nice dip in the market, but then they came back at it and they communicated well. And even though the Fed funds rate peaked at 20% in 1981 in June, that was the peak of the Fed funds rate, the market was on a really nice tear. Then by 83, they had begun to decrease. We're in a decreasing cycle, and we had a massive, massive, massive rally. Isn't it cute that the S&P was like 100? So the S&P went from 100 to 140, then back to 100, and then all the way up to 170. Freaking 6,000 now. Crazy. Those are the 500 best companies in the world back in 1985. And boy, were they different companies. That was 40 years ago, 45 years ago. Oh, yeah, I guess so. Yeah. That's true. You know what? Because if you go 45 years back from here, it's World War II, right? You're into the beginning of World War II. And if you go 45 years before that, we didn't have electricity. So, of course, the companies changed. 45 years is apparently a long time. 45 years ago was Back to the Future. That's when they made Back to the Future. Damn, that's crazy. I mean, that's when I graduated college, right? Yeah. I graduated high school in 81, and I graduated college in 85. So this is my college years. So these are the conditions under which we were learning economics. That's interesting how that sticks with me. I guess that was the basis of my economic knowledge, was starting then. And by the way, look at the S&P. What is that? 90, 100, 110, a little pullback, 120, 130. This is like not even years. This is over a course of 2 years. And massive, massive inflation. So when I had jobs in high school and in college, and even when I started getting out of college, you expected at least a 10% raise every year. If you didn't get a 10% raise, you would tell the guy you work for to drop dead. And we didn't line up a job. This is another thing, because it's like I talked to my daughter and her friends now. They all worry about, like, you got to have something lined up before you quit, and you got to make sure you have a contract signed and blah blah blah. And because God forbid you don't have a job when you're unemployed. We used to just walk out. Remember this, guys? If you're old enough, right? In the 1980s, we used to just quit on the spot. If we were unhappy and we got in a fight with our boss, or and you imagine getting in a fight with your boss now. We used to get in fights with our boss because we were promised something. If we were promised something we didn't get, we didn't go bury our heads in the sand and sneak off. We'd be like, hey, you said I'd get, you said I'd get a company car. You said we were going to get the health insurance plan. You said I was going to get a $50 raise. You'd be like right up in their face and be like, hey, you promised me something. Oh, and remember that? Remember the days when someone promised you something and it counted? Like, God forbid you shook someone's hand on something and you reneged on it. That was a big deal. It's a joke now. I mean, that's gone out the window. Any kind of, I don't know, moral contracts or morality in general is kind of out the window. But yeah, back in those days, we would just quit. And I'm talking about a proper, like, $30,000 job. We would just like say, I'm sorry, I can't do this anymore. I'm leaving. And the guy'd be like, what about you? You're not going to give me 2 weeks notice? And you'd be like, no, I'm not going to give you 2 weeks notice. I'm pissed off. Or you'd say, okay, a week. I said I'll quit next Friday. And that's the other thing. They have to, like, security escort you out the door. They had you worked a week and you left, because again, honor system. You trusted people to be honorable. That was 45 years ago. It seems like the dark ages. But again, 45 years before that you were lucky to have an automobile, and 45 before that, you were lucky to have a light at night in your house. And now, 45 years later, our kids have multimedia computers in their hands at all times. We were having that conversation. Having that conversation with somebody last week. Like, somebody said advanced technology to people who don't understand it is almost indistinguishable from magic. And really contemplate your phone. It's like the newspaper in Harry Potter. Like, it's a little flat thing, but the pictures move and you can have movies on it and all sorts of things. And it would not even be comprehensible to people, not in 1980. I think maybe people could understand it was a small computer or something like that. But still, you couldn't do that stuff with a small computer. You can watch movies on your computer in 1980. A computer wasn't a TV set. That came later. This is 1981. 1984 is when the Macintosh came out, and it couldn't do that crap. And that was a mind-blowing advance in computers. Can you imagine having bought the Apple stock here? Jesus. I mean, but anything though, really, if you bought anything in the S&P here, it's now 30 times higher than it was here. But yeah, I mean, imagine imagine going back now to 1940 and showing someone this phone. You're like a wizard. It's like, yeah, I can do this, I can do that, I can do this, it does that, it makes noises, it says songs, it does movies, it shows you what's going on around the world. We get information from everywhere. I know what the temperature is in Tokyo. Yeah, it's like, that's insane. And now it's an AI, it can talk to you and have a conversation. That's even crazier. So now you're Knight Rider. And how long? In fact, yeah, Knight Rider was a TV show back then. Now, my brother's car talks. He's got the Mercedes electric, whatever the hell it is. And that thing talks to you just like the Knight Rider car. It's like you have a whole conversation with it. And we're very close to the point where it just drives itself like the Knight Rider car. And all you need is a weapon system and you're all set. The show is about a guy in a talking car. But you know what? Was it like 20 years before that? It was Mr. Ed, which was a guy in a talking horse. So shows you the advance, right? But everything, what we've got now is some crazy stuff, and it's getting crazier. Anyhow, so my AI, matter of factly, right? So my AI wrote a timeline because I said to him, all I had to say to him was, give me a timeline of the Volcker's battle against inflation. He summarized, Paul Volcker's battle against stagflation was a watershed moment. Here's the key timeline and actions. That's basically what I asked him. I said, give me a timeline and actions of Volcker's battle against stagflation in the 70s. That's what I told him. And he didn't even, he's smart enough. This is Bodie. He's smart enough not even to say to me, Phil, do you mean the 80s? He doesn't do that. He's like, yeah, okay, I know what he meant. That's a huge leap. The computer does not take me literally, the AI. He doesn't take me literally. I said to him in the 70s, I thought it was the 70s. It was really late 70s, early 80s. He didn't care because he knows what I meant. And he just gives me an answer, just like an intelligent human being would. They wouldn't go back and say, oh, you said it was the 70s, but I'm sorry, there wasn't anything in the 70s. It didn't start until late 79. And I'm like, well, do you have the information from the 80s? Oh, no, I didn't think you wanted it. I thought you wanted the 70s. No, he's smarter than most assistants because most assistants would do that. Anyway, so here it is. My AI puts this together for me, boom, boom, boom. I don't have to sit there and run through it or look things up or check anything, blah, blah. He gives me all the citations in case I think something's wrong. And there we are. Now, why is that important? Because we're going to talk about more AI stuff in further on. The CPI came out where the headline CPI was up 4%, which should have been bad for the market, but because the core CPI was not up 4%, it was only up 2%, everybody's acting like it's time to celebrate. But this market was going to go up regardless, so it's really irrelevant that that the CPI did. There's obviously every intention in the world of this market rocketing up. Oh, she's from the 80s, Laurie Anderson. Let's see. So then, oh, Wayne Walker just asked a question. Look at that. 128, 132, yeah. So he has 30 Whirlpool, 100 calls. I don't like that. Oh, he bought back the short calls. All right, so he had a 110, 120 spread. He bought back the short calls. Can he roll them or what I suggest? What does Whirlpool look like? Let's take a look. Let's see if we can help him. Oh, good job. Yeah, he bought him back. Boy, he's smart. Okay. I like that. So I bought back in December at $19. See, this is exactly what we teach you to do. He had the 100, 120 spread, okay? And the short 120s came back to 19 in December. Wait. Oh, this is monthly. Let's go daily. Oh, here we go, down here. So in December, he bought them back at 110, and now they're at 130. And even smarter than buying them back, he's now saying, boy, maybe I should take advantage and sell some more. And maybe sell only 20 and sell 20, 10, 25 somethings. That is the correct thing to do. Okay, we'll answer him afterwards. There's no emergency here, but we'll answer him afterwards. But generally, okay, so in other words, he's got the 100s, 22, 27, right? And he wants to, and he bought back his 120s at 19. I don't know what he paid for them, but I assume he paid. I assume he sold them for more than that. And he wants to now talk about rolling them out to the 135s, or do something else. Now, my suggestion will be obviously, my suggestion will be that he rolls his 2026s. He has the 100s. He can roll them up to the 2027s, let's say 110, 115, something like that, and then form a tighter a spread above there. So we assume this channel continues to rise. The PE of Whirlpool is only 11.26. So so realistically, it should adjust. It's hard to say because you don't know where, Whirlpool, technically an American company, but where are they assembled? Where are the parts coming from? What are the import tariffs going to be like? We don't know yet. All right, but they just had a good earnings report here. All right, the EPS was not good actually. Oh, so the GAAP EPS, the EPS was good. The GAAP EPS was not. We'd want to look that up before we make a huge investment. But I'm sure it's just marking down some inventories and shit like that. And the revenues were off slightly. But meanwhile, the stock reacted very well to it because it's ridiculously low, because the PE of the stock is ridiculously low. And Whirlpool is a very solid company. And, you could say, oh, bad economic times, housing issues, blah, 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 interest rate issues, blah, blah, blah. But still, how many companies actually make appliances? Where's the competition coming from for them? Not really, not a lot of competition. LG is probably the worst thing that happened to these guys. But still, they've got their market share. Their business is pretty solid. It's a hugely profitable business. And yes, it cycles up and down, but reliably, they make money all the time. It's a good little business. Not going to have explosive growth, but people are always going to buy homes. People are always going to need refrigerators, washers, dryers, and things like that. And Whirlpool is a leading maker of them. So, unless you're looking at an actual recession that dips them for a long time, and don't forget we had a wacky time with COVID, right? So here's COVID. Here's a big dip on COVID. Here's, I don't know what was going on here, but I mean, people were staying home with COVID and everybody was shut in and they had nothing better to do than buy washers and dryers or whatever. But they happened to have a good couple of years, but then that ended. People went back out and decided they'd rather go on vacation than buy a washing machine or a refrigerator. And they went back down, but it's a cyclical business. It goes up and down. But in reality, this is reality. People want washers and dryers. People buy these things as part of their lives. Like, remember when we had COVID and I was really into like shoe companies and Levi's? I was into like Skechers and Crocs and Levi's and the Gap, underwear, Hanes. I want things people are always going to do. When the economy's bad, these are called consumer staples. Let's buy things that people always buy regardless, okay? I don't care how bad the economy is, you're going to want some shoes on when you go out. That's pretty obvious, right? Are you going to want a washing machine? I'm not sure. But you know what? When Whirlpool was down here, we bought it and we did really well and we sold it and we started buying it again. And now we have it again in our portfolio. Anyway, all right, so easy to help. So my suggestion here is always buy time. So you take your 2026 calls and buy more time. You sell 2026, you sell 2027 covers, but I wouldn't go full cover because you can make a tremendous amount of money selling short puts and calls when they move up a little bit more. So turn it into more of an income producing play, leave some headroom, take some money off the table. That's the kind of trade we want to go to for that. Here's the morning report from Warren. Oh, and that's I don't know if I told that before, but that's my new thing now, is because I feel like it's really good for me because I can just write. I used to write my morning report and I'd always be worried about like getting back to a topic and not going too far one way or another on a topic because I didn't want to get too much weeded down in one thing and then not get around to discussing what's going on today. I no longer have to worry about that because I know with great confidence that Warren can write up a general market report that's fantastic right into the opening bell. So the pressure is off me for doing this sort of it's basically housekeeping stuff, all right? Like chasing down these reports and looking at them and describing them and saying he's up this percent, he's this and he's that, and here's what that's housekeeping stuff. It just requires a bunch of reading and looking. And now I have Warren doing that for me, so I can talk about other things that are deeper concerns, let's say, than what each individual stock did today. And he's good at this stuff, sector leadership. You know, I don't tell him to do this. He just decides what's important. But he does have his little format that he likes to stick to. And why does he stick to that format? Because I tell him, because at some point I said, "Oh, that's a great report, thanks." And if I say that's a great report, thanks, that's what he remembers and says, "Oh, that's what Phil considers a great report." I would have to now tell him not to do something, but I frankly think this is a great report, so I'm not going to change it. But that's why you see this, he sort of falls into a pattern, because I have told him in various times that I thought that was very good reading and that he did a good job. So he knows I love to know what my catalysts are, so he's been getting more specific about that. And a rally in EV stocks is notable ahead of the company's next updates. Trump's trade and policies, blah, blah, blah. And I don't, by the way, I never let him read my morning report. So he doesn't read my report before I ask him for his, because I don't want him to be unduly influenced. Well, 40 minutes of talking, and it's getting back to a cough. Should probably go like 2 days without talking. All right, so we talked about oil again, blah, blah, blah. We didn't find Barkin's speech, and now this was fun too, because I asked Bodie, did Barkin say anything today? And he said, I don't see any speech by him. He goes, but in case you're interested, here's what he's recently said. Here's the nature of his comments. So even if he doesn't speak, and you say, well, what would he have said? Here's what he would have said. Because what is AI? It is it's a prediction machine. That's basically what it is. It predicts what would happen from something else. Then we have the news, and this is news I've read and assembled. Then Bodie and I had a conversation about, using, I looked at some stock screens, I looked at some other stuff while I was reading the news, I thought of some things, and so we came up with a bunch of stocks that were playable, and that's why we're here. That's how this all ties together. So stock number one, Meta. Surprisingly, of the Magnificent Seven, Meta still has a long way to go. They are, in fact, Zuckerberg's making fun of Tim Cook for not being, for losing their mojo on innovation and new products and so on and so forth. And frankly, I mean, I don't consider the stupid goggles that Meta has to be any great thing. So I'm not sure exactly what he's pointing to that he's done so well to innovate and impress people, but I'm sure he has something up his sleeve. Otherwise, he wouldn't be talking like that. So I said Meta may not be a terrible pick, and Zuckerberg is getting fantastic at kissing Trump's ass. That's also a very good thing. And they're trading at 23x, which is low for a Magnificent Seven stock. But the thing is, and I said, but the X, the 23 times X, the X is $64 billion freaking dollars, and they have $46 billion in cash with no debt. And I know we hear these crazy numbers all the time now of 50 billion here, 100 billion there, blah, blah, blah. But you know what? It's still money. You hear it a lot because it's the headlines, right? You hear them talk about Musk with 300 billion, 400 billion dollars. You hear Bezos 250 billion dollars, and you think, oh wow, everyone's got that kind of money. No, they don't. It goes down really fast. When you get out of the top 10, it's way lower. And the same goes for companies. You got $1 trillion here and $1 trillion there with these companies, and that's their market cap. It's not their cash on hand. Apple's got $200 billion. Warren Buffett's got a couple of $100 billion, but not many people have this kind of money, and not many people have this kind of money coming in every year. $64 billion a year on a no debt company is dropping to their bottom line. And they don't really pay a dividend, so what do? They could do anything they want. So, they spend a huge amount of money on R&D already. And in fact, that's frankly, that 64 billion net is after they spend $20 billion on R&D. So what could they do with $64 billion? They can do anything they want. They could buy Ford, they can buy GM, they could buy Whirlpool. They could buy, what's Whirlpool's market cap? Let's see. Let's see how much is this thing? Sales market cap, $7 billion. See, they could buy Whirlpool. You gotta have respect. Okay, so there you go. Whirlpool's a $7 billion company. They could buy that with a week's worth of income, or a month anyway. You forget to respect the numbers. They can go into anything they want. They could acquire a pharmaceutical company. They can acquire a robotics company. They can acquire a quantum computing company. So based on the solid business model, the 3 billion user base that they have, the incredible amount of cash that they have, the network worldwide of offices and such that allows them to get their fingers into everything, not to mention the fact that they're probably spying on everybody in the world, so they know what they probably know what in, you know, they know what to advertise to you, right? So they know immediately what your tastes are and advertise to you 5 seconds after you say something. They've got the ad on. Even if you said it in the living room and you walk into your office, they've got the ads already banging at you, right? Why? Because they're spying on you. Apple just got fined $20 for spying on you. So we know they're spying on you. So if they're spying on you for advertisers, you don't think they're spying on you for themselves? You don't think they're you don't think Mark Zuckerberg has a private wall that shows him every trending thing that's going on planet Earth? And all you have to do with your $64 billion is stay ahead of those trends. And when you see a trend, ticking up, you say, oh, let's investigate that sector. Let's get some people there. Let's listen more closely to what the top people in that sector are saying, because we already have all of their information on Facebook to sift through with our AI bot that's now embedded into the platform. That's what Facebook is. And sure, that may sound horrifying to you. That may sound terrible to you, but you know what else it sounds? It sounds profitable. Okay, if Big Brother is going to be watching you and controlling everything, maybe invest in Big Brother. Moral implications are from 45 years ago. We don't have moral implications anymore. We don't do that as a society. Okay, we have winners and we have losers, and I'm telling you that Facebook is, like them or not, they're in the winning side. So then we have Intel, and speaking of, Intel has a VC arm, but they don't have a VC arm with the ear of Facebook. But Facebook should buy Intel's VC arm, frankly, because it would be nice for them. Anyway, you can buy all of Intel. See, another thing, here's something Zuckerberg could buy. He could buy Intel. He doesn't want, why would he want to? He doesn't need it. But more likely they'll buy robotics and do some stuff there. That's my prediction for Facebook. Even though they've been known to make 20 billion a year. So in the past, Intel is capable of making $20 billion a year. They haven't made that in a long time. They're making $4 billion in 2025. But that's only 21 times earnings, and they will increase. It will go from 4 to 8 to 10 to 12. It will happen. So right now is a good cheap time to get into Intel. Still like them a lot. Now, when I was talking to Bodie, he mentioned CVGIs because we were talking about screens of stocks that will benefit from Trump coming in. And I had passed by CVGI because it's too small. I usually don't want to play with a stock that's that small. So effectively a penny stock, 73 million market cap. But Bodie was like, what about, he was like bothering me about it. He's like, what about commercial vehicle group? And I was like, I don't know. Well, let's take a look. So I said, you tell him what you like about it. So this is Bodie's evaluation of commercial vehicle group. The company's trading at 209, market cap 73 million, despite having 91 million annual revenue, extremely low valuation. I'm not sure where he's getting this. I think he's looking forward. I'd say more like 8, frankly. Converging factors that could reverse in 2025. The company just announced restructuring in 3 divisions. Streamline. I love this, though. It's very thorough. The company announced major restructuring in three divisions, streamlining operations, just as the Trump administration. So he's not just saying he likes the divisions. He's saying because the Trump administration is expected to implement policies favoring domestic manufacturing. So he's saying they are structuring themselves to take advantage of Trump's policies. The heavy truck market should rebound in 2026, not 2025, 2026. After a 2-year decline. This timing aligns perfectly with the company's restructuring efforts being completed, with inflation moderating. And he's on the ball, right? Today's CPI 2.9, a bank earnings strong, and the market appears ready to rotate into value stocks trading at deep discounts. The stock has fallen 67%, creating what appears to be a significant overreaction to temporary headwinds, with analysts maintaining $10 price targets, which is a 378% upside in the company's new organizational structure taking place in January 2025. This is a classic case of the market throwing the baby out with the bathwater. Wow. I mean, that's a freaking amazingly good analysis. He won me over with that. I was like, okay. I can see why you keep bothering me that I shouldn't be throwing that one out, because I was ignoring it. And he kept being like, well, what about this one? It was bothering him that I wasn't picking up on it. The key catalyst is timing. The restructuring completion aligns perfectly with both of the expected blah. All right, so that's all his thing. There's all his research, which was extensive because I was, giving him negative feedback. So he kept going back for more and more things to be like, okay, no, I double checked, it's right. And I said, those are pretty good reasons and a whole lot of research. I'd rather wait for earnings, but we'll keep an eye on them. They'd be a great fit for the 700 a month portfolio. Because of the $2 stock, we could do something interesting with it. So we will be keeping an eye on that one. Here's MUR at 33.50. That was an easy one. I mean, I thought that was obvious. They're smack at $5 billion at this price. They make $500 million a year, so that's only 10 times earnings. They've got $1 billion in debt, which is not much for an oil company. They're very active in the Gulf of America, and oil is back over $70, and that means that all the deep water wells, which they have a lot of deep water, and so this kind of the earnings and profits they've had recently does not include any of their deep water operations doing much, because the deep water oil needs like $70 to be profitable, and so for the last couple of years they haven't been doing a lot of deep water work. Now they can get back into it because Trump is going to be very bullish for oil. Because, as I noted, his policies are a nightmare. And because he took $1 billion payment from the oil companies to make sure he drove up the price of oil. So, let's assume he'll be good to his word. So here we did make a play. It wasn't for any particular portfolio, though, but it's a good play. And what we're doing is picking a net $4,500 on a $15,000 spread, but and that gives us, and it's a short term because they only go out till November. They don't have long-term options. So this thing makes $11,500 on 4,500, which is 255% in just 10 months. I mean, you got to take that into account. It's like you can't make 500% in 10 months. It's pretty impossible. But all we're doing, by the way, we sold the $35 calls, so that's here, right? But I meant to say puts. These are supposed to say puts. Sorry about that. Is that a comment? Yeah, it's a comment. Let's fix that. That's human error. This is why we have to eliminate humans. There we go. All right. So the net is $4,500. It's got the 11.5 upside, 255%. And that's fantastic. And so all we needed to do, because it's a 25, 32.50 spread, we're above 32.50. So all it has to do is be higher than it is now. And this is a huge winner. Even if this ends up at 34, it's only $1,000. We'd only be giving $1,000 back, and we'd still have a 10.5 gain. But obviously we can roll the short put, so I'm not even worried about this because this is a good price for Murphy. Right? This is, I mean, they're at 10x now, so I don't mind owning them at 10x. And here's Freeport, and I said I keep wanting to buy them, but it's hard to get motivated to buy them when they're at 20x. But long term, I would have no problem having it. So I said I don't mind owning. If we sell the 35 puts for 5, right? They're at 40. We sell the 35 puts for 5. We're netting in for 30. So I wouldn't mind doing that right now. If I was looking to do something with FCX, I would just sell the 35s for 5. And if they drop down to 30, I would then do a roll and a double down most likely. And then we'd have 2 times and probably net in for 25, not 30. And then if it went down again, I would then do another roll and we'd net in at 20 on a larger position. And then I would be like, boom, then I'd be like really getting at it and starting to add long calls and so on and so forth. So even though I would like it to be lower, I don't mind starting an entry here because there's a path to having a really good large play on FCX back here where I wish we had bought it, right? I wish we bought it here, but so in other words, I wish we bought it here, but I can put it in my portfolio by selling the 35 puts for 5. That nets me in for 30. And then my worst case scenario, my worst case scenario is it doesn't go down and instead it goes up and I only make the stupid $5. That's my worst case scenario. It's like, I don't want $5. I want it to go down. I want to double down and I want to double down again. I want to own it for net 20. That's what I would like to happen, but I can't make it happen. So for now, I content myself by selling the puts and establishing a small position. Then we have FHN, because we're looking at financial stocks. Also an easy one, like very obvious. These guys are at 13x, which is frankly around where financial should be. 13, 15x is normal. But they have 800 million in profits. So they're in good shape. They're healthy financially. Earnings are coming up. They're not out yet, so we're going to wait. We'll see what, well, we don't have to wait, but I'm saying I predict goodness because based on what their peers are reporting, it looks like they're going to have some good numbers. And so the trade we do is we're going to sell the $20 puts. They're at 21.30. We sell the $20 puts for 170, and that nets us in for 1830. 1830 is down here, more than 15% below the current price. And I said, and the $20 calls are 335. So I said, selling both of those against the $15 calls at 7. So the $15 calls cost 7, and 7 is only 22. So really, you're only paying 70 cents in premium for those. So the $15 calls at 7 only have 10% premium. And we're going to sell the $20 calls for 170, and we're going to sell, I'm sorry, the $20 calls are 335, the $20 puts are 170, and that nets you in for 195. It's 7 minus 170 minus 335 is 195 on the $5 spread. So you have 100% upside. I'm sorry, this trade, which is 100% in the money. The trade is currently 100% in the money with 150% upside as long as they don't fall below 20. This is just giving money away. That's in 1 year. Okay, so we like First Horizon. They're at 13x or 1375x. We make a play where if they stay over 20, we make 150%. Options are freaking amazing if you know how to use them. And there's not a big risk here. In fact, if the risk would be if you got completely wiped out of this trade because you weren't paying attention to it, and you recovered not a penny, then your net cost is $2 on the $20 calls, so you'd be in for net 22. How much is it now? 21.30. So your worst case scenario is that you own shares for $22 each. That's the worst thing that can happen to you. And we still like it at this price, and we could sell more puts and calls if we get assigned and do that. And that again, that's not just the worst case, it's the worst case, and you are negligent in managing your position. So the stock goes down and you're paying no attention and you take no action and you let it run all the way down to zero and don't take a penny off the table. That's what has to happen for you to end up owning it at 22. Any other action you take, you'll own it for 20, 19, somewhere around that 18. You know, you can be in that range. Rolling the puts, doing all sorts of things. You can save it. But if you don't save it and you act like an idiot and you trade like a moron, then you're at 22. So if that's your worst case, it's a great play. Here's Wells Fargo, terrible bank, awful people, rob their own customers, but nobody seems to care. The customers are still there. And you know why? Because in the Midwest, it's Wells Fargo is like everywhere in the middle of the country. Down in Texas, even in Florida, all the way across the bottom of the country, all the way in the middle of the country, it's a Wells Fargo. Why? Because again, you don't have to. It's funny how little you have to go back. You go back 45 years and 45 years, and you're at the beginning of the century, and you go back to I'm sorry, you're at the middle of the last century. You go back to another 45 years. Now you're at the beginning of the last century, and from at that point, Wells Fargo was huge because the Wells Fargo wagon was how, you know, they were like the original Sears basically, or Montgomery Ward or whatever, but that's how people got things. They had catalogs and they would order, and the Wells Fargo wagon was UPS basically, and they would deliver all over the country all the goods and services from one place to another. And at Wells Fargo wagon, horse-drawn wagons. That's what we used to have, and that was the original UPS structure. And so at a certain point, they ended up building banks because, you know, and they don't build banks because they're geniuses or anything like that. They're building banks because they're like, we're getting all this money and we don't know what to do with it, and we're riding around in stagecoaches and people are robbing us. So instead, why don't we put banks in all these towns that we're visiting so we can also move money from place to place, and we can also you know, have another kind of business that transfers funds and exchanges goods and so on and so forth. So they did that, and that means that in almost every town in America, in the middle of the country, Wells Fargo Bank is one of the banks. And so they're very, you know, that's why they're so popular, and they're the bank that your grandfather used and your father used, and it's like your whole, you know, everybody swears by Wells Fargo. It's like the bank. All these other banks is Citibank and JP Morgan, Chase Bank, and whatever. These are all newfangled banks. The bank your parents and your grandparents used was Wells Fargo. So that's why even when they steal from you, the customers are still like, well, they're still the best bank. They're still my bank. So active trading on the options, right. So here I would sell the $65 puts, which are quite, you know, quite low, and that's based on the fact I don't like them as much as most things. I don't want to aggressively play them, but they're only trading at 13x. They don't grow much, so I'm going to play the whole thing low. So $65 puts you sell for 6, you buy the $60 calls for 20, you sell the $80 calls, and we're selling less $80 calls because I intend to sell short-term calls. So we sell these for 6, we buy these for 30, and we sell these for 11, and that's net 13,000. And now we're going to sell 7 April 75s for 3,000. So now we're down to about 10,000, or 999, whatever. So now we're down to 9,000. So we're down to $10,000. Forget it. On a $30,000 spread, so we have what, $20,000 upside. We're 22,000 in the money at the moment, and we have 200% upside potential. But we also see, here's what I love about this one. Not only do we have a 200% upside potential, but if we sell every quarter, if we sell 7 calls for $3,000, we can make $21,000 additional dollars just selling short-term calls. That's 200% more. So this could potentially be a 400% play for upside. And like I said, we're starting out $22,000 in the money. It's a very, very conservative play with a 400% upside. That's crazy. But again, options are freaking fantastic. And you know what? Even this was not the top trade that I chose in the end. Ozark was the top trade. So Ozark, because again, I'm seeing these nice bank earnings, and I'm like, oh, who fits the profile? Who's going to be a good bank that's being overlooked so far? Ozark was a very good little regional bank. They're at 45 bucks. It's $5 billion on the money. They're making 660 million, so they're at 7.5 times earnings, and they're growing. And not only that, but they don't have debt. They have $1.6 billion of cash. It's a bank with no debt, which is impossible to find, making $660 million, which is 7.5 times their valuation. I mean, whatever, 7.5 times 660 is their valuation. And that's not even taking the cash. What you really have to do is take the cash out and then say it's really being valued at $3.4 billion and they're making 660, which means they're at 5 times earnings. It's insane. I mean, frankly, this bank should be taken over, because it's not for the bad reasons. It should be taken over in a leveraged buyout. It's crazy that they got this low. And why are they this low? Because they're this low because they haven't grown. Their earnings are growing, their profits are growing, but their stock price is languishing. But you know, when you're a value investor, I don't care what other people think it's worth. I don't care that people are undervaluing it. I'm getting back my money. Every year I'm getting back, and again, the cash in the bank. So I'm getting back 20% per year based on a 3.6 billion value, 3.4 billion valuation. But based on a 3.4 billion valuation, I'm getting 20% of my money back each year out of this bank. Why the hell wouldn't I want that? So I'm thinking that over the course of the next 2 years, somebody besides me is going to notice that this bank is way too cheap. Our play is not aggressive because we're $10 in the money. The puts are at the money. The calls are 10 below the money. So $20,000 of this spread, and it's a net 9,800 spread. So we're 20,000 in the money on the $9,800 spread, and it only has to go up 10% for us to make the full 30,000, or to make 20,000, 200% gain. And I said, so that is your 200%. But also, when we do get up to 50, they're going to start hitting resistance, only because people are stupid and undervalue them. And then we'll start selling some short calls. And I said, at the moment, the April 45 calls are 325. So 5 short would fetch 1,600 bucks. That is 16% of what we laid out. 16% of 9,800 quarterly is like a dividend that we're paying ourselves. So if we can sell the 50s for the price of the 45s, if they pop and we can sell the 50s for $3, we're talking about giving ourselves 16.5% per quarter at our strike price, at the strike price we expect to be at. So there's 8 quarters to sell. So 16, 32, 64. So we can make 64% back on our money while we wait this year and next year another 64%. And then if we get called away at 50, we're going to make the rest of the other 200%. Options are freaking fantastic. And you know why they are? Because the vast majority of the people fact, basically almost anybody who isn't a member of our site, they tend to play options the other way. So in other words, there are people who are buying the $50 calls. Obviously, we're selling them to somebody. There are people buying the $50 calls. Why? Well, good reasons, because they see this bank at 7.5 times earnings. They say it should easily go up. If it goes up 10%, they're only going to be at 9 times earnings. Or not even 9 times earnings, they'll only be at 8 times earnings at 10%. This bank would have to go up 30%, 33% to get to 10 times earnings. 33% on 45 is 60. So a reasonable person could say this thing is worth 60 bucks. If it's worth 60 bucks and they buy the $50 calls for 6 bucks, their upside on $6 is $4 more, right? If it gets to 60. And that is 66% of what they're paying. And there are a lot more people, for terrible reasons, by the way, terrible reasons, there's a lot more people who want to take $6 and make 10 and get 10 back on this bet than there are people who want to go through the hassle of laying out a proper amount of money and making 200%. Don't forget, the guy paying 6, he can only make 66%. That's his cap. At 60, that's his cap. Oh, I'm sorry. No, it's not his cap. I'm sorry. It's not his cap. It could go higher. He can make more money. We're the ones that are capped, but we're capped at 200%. I would so much rather be me than him. But you know, as they say, there is a sucker born every minute, and that's who we sell our options to. We are not options buyers. We are options sellers. It's a whole different ball game. That's the whole concept of when we say be the house, not the gambler. Options trading, no casino gambling, not even if you get on the other side of the craps table. There is no game in Las Vegas that is better than options trading. You get to be the house. You get 100% of the benefit of being the house. There's no action against you. If you use our strategy, you have the edge. And all you have to do then is be a reasonably good stock picker, and you will do fantastic. All right, so there you go. That was pretty good. And now we're ready to move on to the Beige book. Yay! And for the Beige book, we will engage the services of Warren. Let's see, where are you, Warren? Takeaways for the economy. So I'll make sure this isn't, this is not, okay. I want to make sure this isn't the Warren I'm using for my daily wrap-ups and things, otherwise he'll get all confused. All right. So now we are going to get the Fed Beige book, Fed Beige book. And here's the current one, but I want to get the old one first. And I don't have it. Ah, you're kidding. Archive. Beige book. Okay. Here is the November and January Beige books, please. Summarize the changes from one to the other and let us and give us the highlights and your insights as to how the changes may swing Fed policy and what they indicate for the economy. Seeing the difference between Warren, who's an AI, and Bodie, who is an AGI, is Warren is going to take me more literally, so I have to be more careful what I say. As I said before, with Bodie, I can be totally wrong and say something stupid, and he understands that I was totally wrong and said something stupid. Warren would be more prone to trying to justify what I said. You know, he'd be more confused and try to look at it that way. So you have to be a bit more careful what you say to an AI. And also, I don't want to confuse him. So here's the Jan report. Okay, don't have that yet, but I have faith. Nope, where'd it go? Here it is. HTML. There you go. Now notice I'm not telling him how to format it or what to do or whatever, but he has a pretty good idea of what I like. Okay, just gonna write this faster than we can read it. Oh, gotta wait for him to finish. Wow, I thought this was going to save my voice, but it's writing the whole Beige book. Holy cow, dude. I'll just read the conclusion. Modest improvements in economic activity and optimism compared to November, driven by stronger consumer spending, labor. Excuse me. Labor market. However, ongoing challenges in manufacturing, construction, and agriculture, coupled with rising delinquencies, suggest the economy remains fragile. The Fed's cautious approach to rate cuts and its focus on data dependency align with these mixed signals, pointing to a steady but measured policy stance in 2025. Holy cow. Okay. Oh, you know what? Let's let the kids see it. Dun, dun, dun. Give credit where credit is due. Messes up the formatting, unfortunately. Oh, nicely organized, though. What a lovely report. It's fine. There we go. Okay, all good. By the way, Control A and then Control C. I do this every time before I hit post because just in case it gets lost, then I've got it in my, and I've got a copy of my comment. All right, so I may as well read it here. It's nicely presented. Changes between November and January Beige books. Economic activity rose slightly in most districts. Modest growth offset by, okay, all right, let's read. I'm just going to read January because again, my voice is going to go. Economic activity increased slightly to moderately with stronger holiday sales and a modest improvement in vehicle sales. Optimism for 2025 increased. So he's saying growth became more broad-based since January, with stronger consumer spending and improved optimism, though construction and manufacturing remain weak. Consumer spending grew moderately, boosted by strong holiday sales. Vehicle sales also grew modestly. Holiday sales exceeded expectations, providing short-term boost to consumer spending and highlighting, we talked about this at the holidays, highlighting resilience and discretionary expenditures. Labor. Employment ticked up slightly in 6 districts, particularly in healthcare and construction. Wage growth picked up to a moderate pace, but remained uneven across the sectors. Slight improvement in job creation and wage growth, persistent challenges in finding skilled workers. Prices. Pricing increased modestly to moderately, with input costs rising, particularly for insurance. Oh God, insurance is going to be a nightmare. Oh, we forget about that, right? Because insurance is going to be an insane increase this year. Some contacts noted that flat or decreasing prices in retail and manufacturing. Continued modest price growth with more mentions of flat declining, signaling softer inflationary pressures in some sectors. Manufacturing decreased slightly. Oh, and the New York manufacturing was at -19 today. I forgot to mention that. So the same horrible thing it always is. It's always much worse than they think every single time. It's just incredible that they even keep bothering to mention it like that. Yeah. So manufacturing weakened further, reflecting cautious investment in tariff-related disruptions. Just you wait, right? Wait till next month. Construction and real estate. Construction activity decreased overall, constrained by high cost and financing pressures. Residential real estate remained flat, while commercial sales edged up slightly. Now, interesting thing about the wildfires is money is locked away in insurance companies, right? And money will be created by the government, and overall, $200 billion is going to go to California over the course of this year to start rebuilding all that was lost. So that money was spent over decades building homes and so on and so forth. Horrifying as it is, Keynes used to say even a broken window helps the economy. And that's essentially what these fires are. They're a huge broken window. They're going to create a massive construction spending boom in California. Materials, workers, washers and dryers, right? Suddenly thousands and thousands of homes need washers and dryers because theirs burned up. So it is a very large change and a very big benefit for the California economy, which is again why the Republicans want to withhold the aid, because they're like, well, this would be the worst because we're like now giving money to California. Like that's not what the Republicans want to do at all. So big benefit for California. Overall, it's a boost to the economy. Anytime somebody spends $200 billion on anything, it's a boost to the economy. But no, not even but though. We're a $20-30 trillion economy. But that doesn't matter because $200 billion is still 1%. 1% is 1%, 1% of your GDP. And by the way, it's not 1% because when you give 1% to the construction worker, he spends it back in the community. That's now 2%, right? The money recirculates, and then the people he spends the money with spend their money, and so on and so forth. And the same goes for like when they go to Home Depot to to rebuild the home, they buy lumber at Home Depot. Home Depot pays the lumber company. They pay their workers in Home Depot, so on and so forth. So there's a multiplier effect too. So you're talking about a boost, maybe 3 times whatever the aid is what the impact is to the GDP. And so you're talking about a significant, huge boost to GDP. But then you're talking about massive inflationary pressures because now there's a huge demand for lumber. There's a huge demand for washers and dryers. There's a huge demand for roofing, for roof tiles and things like that. Suddenly there's a huge demand for labor, for construction workers. So now you've created a huge upswell of demand as well. But you're talking about, a possibly a 2% boost to the overall country's GDP. It is let's see, California's economy is about, I would say, $4 trillion, something like that. So the GDP of California is like $4 to $5 trillion. Even so, this is a 10% boost to California's economy. And again, the Republicans are freaking out. They do not want California's economy to improve by 10%. God forbid the lesbian mayor or the lesbian fire chief and a black mayor. Is that what they got? And then they've got Newsom. I mean, could you imagine the nightmare of those guys looking good? So anyway, things to think about. But we're talking about nationally, a national 1 to 2% boost. That is very hard to say. 1 to 2% boost in GDP nationally. And basically all Trump has to do is, frankly, all Trump has to do is sit back, send the money over. It's not much in the grand scheme of things, a couple $100 billion. Send the $200 billion over, sit back and take credit for the incredible 5% GDP growth we'll have next year thanks to this. He'll say that's all him. In fact, they'll probably have the idea to burn down some cities every year. Why not? So construction activity decreased overall. That's totally out the window now. Constrained by high costs. There are no constraints. Financing pressures, no financing pressures. If the aid goes through, it will obviously make it harder on people in the rest of the country. But the fact of the matter is still hundreds of billions of dollars being spent where they weren't going to be spent before. It's a huge thing. It's going to be massive, and we should really look into the companies that will benefit from this thing. The fires, thank God, this week are getting under control. The winds picked up, but they've sort of gotten their arms around, preventing it from spreading further. There are more firemen there. They've sent firemen have come in from all over the country. Equipment's come in from all over the country. Canada and Mexico have sent fire brigades over also. There's an incredible amount of help. It's actually wonderful what's going on the ground in California. I mean, people are just really, really chipping in to help this. And that's without government money or anything else. They're just getting there and doing what they can. And these celebrities that everybody hates are all doing what they can. You see a lot of people. I saw Jay Leno handing out food. Somebody else, one of the other rich people, I think it was Paris Hilton actually. I mean, they're like, they're like feeding all these fire people and contributing food and organizing, changes in places for them to sleep and so on and so forth. It's crazy. Because you think about that, these guys get on a fire truck from Vancouver, and and a dozen firemen from Vancouver come down to California to help out. And they don't have a plan. They don't know where they're staying. They don't know what they're eating. They don't even think about that. They're there to fight the fire. It's a huge thing. I mean, can you imagine? But that's what people are doing, and thousands of people are doing it. Thousands. And that's what's cool about it. I mean, and to me, that's why to me, that's human nature, right? I mean, people are generally nice. It's like I don't get so down on humans because I see this kind of stuff happening. It's really amazing. Anyway, so where are we? January, lending activity grew modestly. Concerns now, again, lending is going to be huge in California too. Concerns about delinquency among small businesses. That's going to happen. That gets worse with the fire, right? Lots of small businesses suffering. Lower income households, we should all be concerned about that. I've said for a long time, these people are running out of money. And I'm talking about the bottom 60% of the country is basically broke and living paycheck to paycheck. So it doesn't take much to tip people over the edge. Modest improvement tempered by delinquencies, financial strain among vulnerable borrowers. Agriculture and energy. Agriculture remained weak with additional challenges from avian flu. This is bad if it gets out of control. We've got to be real careful about that. Energy activity is mixed with growth in some regions, but stagnation in others. Because why? Because demand obviously is way down. If we weren't exporting 5 million barrels a day, we would be drowning in oil. 5 million barrels a day have to be shipped out of this country or we drown. And by the way, next time there's a storm that shuts down shipping or anything like that, keep that in mind. We export 5 million barrels a day. We import not even 2 million barrels a day. Okay, so every day that the shipping is shut down, we build oil in this country. We don't lose it because we have a massive surplus already, not because Trump did something. Optimism about 2025 increased. This is post-election stuff. Though concerns over tariffs, immigration, this is post-election stuff too, tariffs, immigration, and policy uncertainty persisted. Broader optimism driven by strong holiday spending, but tempered by ongoing uncertainty about policy changes. That's why I don't want to do much until we see what Trump actually does. They're doing a fire report right now on CNBC. Wow. These neighborhoods are like completely wiped out. Okay, for the Fed, improved consumer spending and labor market resilience, stronger than expected holiday sales, and modest job growth indicate resilience in consumer demand and labor markets. These factors support the Fed's decision to ease rate cuts, but may prompt caution in further easing if consumer momentum proves short-lived. Inflationary policies, both reports highlight modest growth and increasing difficulty for business to pass on costs. This inflationary pressures are moderating, aligning with. See, to me, I don't necessarily agree with that. If my voice wasn't bad, I would have gone, voice bad, timing, and all that. But if I'm doing it, usually I'm going to go back and forth with him, and we're going to dig deeper into this part because modest price growth and increasing difficulty passing on costs. That doesn't mean inflation is moderating. It means that the consumers ran out of money. So if now the producer price index came in lighter, all right, so that was a good sign yesterday. Today, the CPI is still rising, and what they're saying here is they're getting a lot of pushback on these price increases. That's where you end up, if they can't control the cost on the producer side, then they're going to have a margin squeeze, right? Because their costs keep rising and the consumers can't afford anymore. That's what happens when you talk about that. Inflation pressures are moderating, but it's not because they're just getting cheaper, but because the consumers haven't got any more money. Everything you do to them now is a choice. If you raise the price of this, then they got to cut back on that. There's not like they're going to just say, "Oh, it's more money now." See, the problem is we're in the investor class, so we basically say, "Oh, it's gonna cost me $1,000 more a month for my health insurance. That means I'm not going to buy. That means I won't buy 50 shares of Apple stock this year." That's how we make choices. We would have spent the money anyway on something else. We would have taken a trip that maybe we cancel the trip. If there's something, we would have spent money because we have discretionary income that we spend and investing income that we spend. People in the bottom 60%, they don't have anything. They got their day-to-day paycheck, and they don't. At the end of the week, it's exactly this much money. Come on, you guys remember living like this at some point in your life, most of you. Right? You remember college? You remember being poor at some point? For whatever reason, not everybody went through their whole lives being rich. And the bottom line is, if one thing goes up, then something's got to get cut. And that's the feedback that the manufacturers are getting now. They can't just pass these costs along to the consumers. So they have to now put the squeeze on their suppliers, and their suppliers have to put the squeeze, and so on and so forth. And if that doesn't work, then margins shrink, and then other choices have to be made. But the big thing happening now, this is what you really got to watch out for, is because when things like insurance, property casualty insurance, auto insurance, so on and so forth, health insurance, when those go up, people have to have those things. So they can't cut that. They have to cut something else. They have to stop buying the Post cereal and buy the store brand cereal. They have to just find ways. They have to buy. They buy less shoes. They wear their clothes long. They wear their underwear until it has more holes in it. You know, there's a lot of choices that get made. They see less movies out of the movie theater. They don't drink. They can't afford to drink as much. That's, by the way, a big thing happening now. Is drinking is coming way down. You know, they don't go out to Fridays or Red Lobster. Both of those chains just went bankrupt. And you can blame Ozempic for that also. People aren't eating junk food as much anymore. By the way, I was watching, I don't know what I was watching. I was just watching TV. Let's just say I was watching TV, which I frankly don't want. Yeah, that's what it is. I don't watch commercials usually. Like I avoid commercials like the plague. So for whatever reason, I was watching TV with commercials last week. And I mean, I was shocked at the food that is advertised to us as Americans is completely insane. There is almost nothing that isn't breaded and fried and dough'd and then refried and then covered in chocolate, blah, blah, blah. There is no one advertises a salad with tofu. Nobody is selling you a steamed chicken and broccoli in a commercial. It's freaking insane. I mean, it is literally non-stop bad choices being advertised to you that, like, anybody who understands nutrition would be like, this is not good. You can't eat this. You shouldn't be dreaming about this. You shouldn't be having music set to this thing and it's shown in glorious close-ups and turned around on a turntable and glistening under the lights and blah, blah, blah. It's like, oh my God, it's like everything they advertise is shit. And then you wonder why the country is so many overweight people and so many out of shape people, and we spend more money on healthcare. It's like we don't do the right things at all. I mean, and it's crazy, and nobody regulates any of this. And God knows, they don't expect that to change in the next 4 years. But holy cow, we are just crazy people. Anyway, that's my statement on that. So, diverging sector trends. Weakness in manufacturing, construction, and agriculture underscores the uneven nature of the recovery. The Fed may need to consider targeted measures to support these sectors, especially what targeted, see, this is where you run into problems with AI. The Fed may need to consider targeted measures to support these sectors. Wow, how is that going to happen? They're not effective at anything. I mean, they're going to sit there and target specific sectors to improve with Fed policy. It's not that kind of instrument. So he has misplaced. So Warren has misplaced faith in the Fed's ability to adjust things. Rising delinquencies among vulnerable groups. Concerns about delinquency in small business and low-income households highlight the growing financial strain. For sure, this could influence the Fed to adopt a more accommodative stance to prevent broader financial stability. And again, is it their job to do that? Monetary policy. Fed may continue gradual rate cuts in 2025, but will likely maintain a cautious approach. Weakness in sectors like manufacturing may prompt the Fed to slow the pace of balance sheet runoff to maintain liquidity. That's true. That they could do. The Fed will likely monitor inflation, consumer resilience, and credit conditions closely as adjust policy to ensure sustained growth. And again, they're in an easing cycle, not a tightening cycle. The Beige book reflects modest improvements in economic activity and compared to them driven by stronger consumer spending, labor market stability. However, ongoing challenges in manufacturing, construction, agriculture, coupled with rising delinquencies, suggest the recovery remains fragile. The Fed cautious approach to rate cuts and its focus on data dependency align with these mixed signals, pointing to a steady but measured policy stance in 2025. So that's where we are. I don't disagree with that. I just disagree with the fact that he thinks the Fed can actually fix things. So now, let's see if anybody had any questions. Oh, no questions. I must be doing amazingly well. All right. So now if we look back at the portfolio review. Oh, by the way, I also did a top trade review on Sunday. So you guys should check that out. That goes over all the top trades from the second half. And we also do adjustments from the first half for the ones that didn't work out. But we ended up where we always end up with top trades. We're about, about a 70% winning streak, a 70% accuracy. I think the year before we were 80%. So it's and markedly worse in the second half of last year. So it's getting harder to pick these stocks, and that's why we cut back on our picks, because there's just not that many easy picks to make. And that's my attitude about these things. It's I wrote a whole thing in the top trade. I'm not going to get into it, but my attitude about this is top trades are the trades that we're most sure about and that we feel very strongly are going to succeed. If I don't have a trade like that, why would I make a top trade? I can't just make it because it's, because I say, oh, it's near the end of January and I haven't made any picks. I've made 3 already this month, so it's not true. But if I get to the end of January and I haven't made any picks in the last week of January, I got to go, oh, I got to make a top trade pick because I didn't make one in January. That's a terrible reason to make a top trade pick. The way I did make a top trade pick today is we looked at whoever it was. Anyway, we looked at the trade. It was so obvious and so likely to succeed that I made it a top trade, but not the other way around. I saw a trade that was so good, it was good for a top trade because I believe it is 80% likely to win, at least. So if I think something is 80% likely to be a winning trade and has the right catalyst and the right timing and so on and so forth, that's what a top trade is. Not today is January 25th, and therefore I must find a trade that has the right timing and the right catalyst. That's obviously not a good idea. That's not the way you do something. So it's an approach, and the reason that we have a 70% winning rate with our top trades. And by the way, if you just basically put $5,000 on every trade and you win 70% of the time, you're going to make a lot of money. I'm talking just cash on the stocks. Forget the fancy option plays. That's how we make a fortune. I think we made like $200,000 last year. But that's with options. But I'm saying if you simply took the trades and put 5,000 on each one and 70%, they have 7 winners for every 3 losers, you're going to make a huge amount of money. And especially if you use like intelligent stops. So that's what goes behind the top trades. This is not the top trades. This is just our portfolio review. Notice the S&P is back to here's Trump. Here's Trump's election. Here's right before Trump's election. We are back before Trump got elected. We are back here in October. I think in October we kind of thought Camilla was going to win, didn't we? If I remember correctly, we still thought Trump was going to lose back here. So that's our argument for support. It's like we thought Trump would lose and we were here, so then they thought he was winning when we got all this, but it's gone. It's all gone now. Now we're going to see if he can actually pull anything off. But if he disappoints, we'll be right back to here. And we should be right back to there because there's no reason we should have gone here in the first place. Economic conditions are not great. And what Trump plans to do is even not greater. So this is the short-term portfolio. These are all of our short puts. Very green though, very nice, right? Those are all the short puts we sold. These are part of our SQQ hedges. Also green, very nice. Anytime you see green, it's good, right? Here's Best Buy, very, very green. This 28 cancels out this 27. That 37 is canceled out by that, and the rest of the greens are all profits. That's how I look at things. I look at them real quick like that. I'm like, okay, well, that one's going well. You know, I look to see if I got things that cancel other things to make sure I'm in good shape. CPER is a copper play. That's going well. Ford, not well. So we obviously did something with that. Skechers, again, sneakers. Love my disposables. Skechers is this is canceled by this. So this is canceled. This is a very big win. SQQ. Look, 180 cancels 109, cancels 16. Very nice. And we know we have two greens up there. So we're in very good shape on our hedge on the SQQ. TZA, green, 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 green. So obviously big winner on TZA too. Very good. And this was before we bounced back. This is from 2 days ago. No, yesterday. Actually, it was yesterday. But it doesn't matter. You know, it's in other words, this balance really doesn't matter. The point is that we know that if we have a big sell-off, it works. We win. We're at 710. Oh, here you go. I'll tell you right now. Oh, come on. Portfolios. Short-term portfolio. Ooh, 268. 736. Oh, that's weird. Okay, I'll take it. So even though we bounced back, we actually have more money. We had $26,000 more dollars than we had yesterday. And you know why? I didn't make the adjustments are not reflected here. So I mean, that's because we sell a lot of premium, and when it bounces back, we benefit. So it's a brilliant structure. I got to tell you, the way we do this, and I've perfected it over 20 years. But the way we balance these portfolios and the way we arrange these hedges it's ingenious because we take full advantage of premium decay and the timing and the relative deltas of each position in each leg, so that the combination of theta time decay and the delta, which is the positioning decay, the combination of those working over time compared to the generally tight spreads that we take over the long haul can give us tremendous profits. And then if we time our short-term positions correctly, and we play for the bounces correctly, and we sell the short terms correctly and cash them in at the right time, then we just goose our profits tremendously. And of course we have, because we're up 255% on this freaking portfolio in a year. This started May of last year. We take advantage of this. We don't just sit there and use it as a single hedge. We take advantage of it, and it's phenomenal. Best way to hedge in the world. I've never seen anything work better than what we do, and that's why I teach it. That's why people pay good money to learn this stuff. So Levi, I said was good for a new sale. Merck, we made it into a bigger position because Merck got so cheap that I wanted to build on it. Moderna, I said we just got out of the Moderna business in the short-term portfolio because we already have a big position in the long-term portfolio. Micron, great for a new trade. RTX, we closed it because it's a big winner, but we closed it because it's $770. We got to wait another year to get 770. It's not even worth looking at for 770. It's an opportunity cost, even if it's not a big deal. The fact just having to make a decision every month and think about it, I'd rather say, oh, I got room for another put and we could do something with this. As I said, with Best Buy, messy but profitable. Board, we moved it to the LTP and made a much bigger play out of it. Skechers, we're just doing the normal selling short calls. SQQ has 527,000. So it's doing well, we saw that, but it still has $527,000 of downside protection from where it is. That's what we care about. How good of a hedge is this? It's nice that it's making money, but I care more about how much protection am I getting. This is my insurance policy. And then TZA has $764,000 of downside potential. And that's what I care about. And don't forget, that's against a 20% drop. And why do I like to protect against a 20% drop? Well, first of all, because they shut the market down if it drops 10%. So it's very, very unlikely that we're going to get caught with our pants down in a market collapse, because they are going to shut the market down and reopen it the next day. And then when they reopen it the next day, if we wake up to a 10% drop and they hold the market, you know what we do? The second they open the market, we're going to be adding to our hedges. That's the first thing we do when they open the market back up. If something, you know, I'm talking about like a 9/11 kind of thing. If something so horrible happens that, or Trump nuking somebody, whatever, you know, things that can easily happen. So if something really terrible happens and the market goes down 10% in a day, and when the second it reopens, we know what we have to do. We have to add to our hedges. But we'll be able to quickly double our hedges before the market drops 20%. We'll be able to double our hedges. And what are we going to do? We're going to make a new set of hedges that cover us from 20 to 40%. And then if it goes down to 20%, past 20%, we're going to cash in the entire play, right? We would cash in our $1 million+ of that we hedged for minus 20%. We already added the 20 to 40% group, and now we're going to add a 40 to 60% group. So when I say we have $1 million worth of protection, we really have $3 million worth of protection against a 9/11 kind of event, because we know how to make the next set and the next set of hedges. So it's better that it's always a lot more than you think. But the point is, we like to make sure it's performing well. And I love the fact that we just had this pullback. The S&P is down 5%, and we made 25% of what we expected to in the short-term portfolio. We made a couple of $100,000. You're not going to make all of it. So in other words, a couple 100,000 times 4 more would be 8. So we're on the pace to make a quick 80%. Why not 100%? Because it's time. It's too far out. Our hedges are far out in time, which protects us against the market going up. But it means we're not going to really collect the full value of our insurance in the short term. But still, we're going to collect 80% of our planned insurance in a short-term drop. That's what we love to see. And since our total net was 1.2 million, we will collect $1 million on a 20% drop. That's perfect for us. It's before we have to add any more collection, any more hedges for downside correction. All right, now, so on to better news, the $700 a month portfolio. Okay, we were down, and then we suddenly came back up, and now we're actually ahead a little bit. So we dipped, and a week later we're back. And that's the vagaries of options, because you know these numbers can change pretty drastically, you know that. But that's fine with us, because you know we ride that out because we have confidence, and that's why we always, you know, I always talk about the net of a spread and where we are and are we on track. So in other words, STLA is at 1250. It's halfway between the two, and we have until 2027 to hit our target. So this spread's fine. It's negative $100 right now, but it's fine. It's right on track. We're halfway to our goal with 2 years to go. And here's Blackstone Mortgage Trust. They're doing okay. Don't forget, this is a absolutely no margin portfolio, so we have to be very careful about the positions we take. So these are all nice little positions that are made to be, you know, played with $1,000 or less. So if you have that kind of interest, it's great. And we're up 90% in 2 years. So it's a great portfolio too. Good profits considering the limitations. And let's see. Oh, and here's the Money Talk portfolio. Now the Money Talk portfolio is only up 8%. That's pretty new. We only restarted in August. And these are our early trades. We only spent $23,000 on the initial trades. And those trades are up. Well, those trades are up $8,000, right? So we spent $23,000 and we're up $8,000 overall. So really we're up 8,000 against 23 though. That's where we're at. That's why, you know, people get disappointed when we start these portfolios, because 8,000 divided by 23 is 34%. which is what we're usually up, in 6 months. I know that sounds crazy, but we're very good at this. So that's a normal amount for us. But the problem is we're only starting with small amounts because we don't just sit there and right away buy and spend all our money. We wait for opportunities because we're very confident that over time we'll consistently make that kind of money. So are the positions good? Well, that's working out, and that's working out, and that's working out, and gold is not working out, but I would totally buy more of that. I probably did if I looked down. That's flat. That one is down a little bit. That one is working out. That one flat. That one flat. That one working out. That one down. Exxon. Ooh, Exxon is down. That's weird. Oh, and is that right? I thought I finished the, oh, I can't make changes. I'm like, I would change that and I would change that, but I can't change that because we can't do it until we're on the show in February. So next month we'll make adjustments. That's why I stopped there, because I can't make adjustments. So we'll see what happens in the first month of Donald Trump to affect this portfolio. So now I have to do the income portfolio and the what's the other one? Income. Wow, I'm drawing a blank on what the other portfolio is called. Butterfly. The butterfly, the income, and the long-term portfolio. Those are the ones I got to finish up. So that's my week, because this is, as you can see, going over these things one by one is really hard work and uses a lot of brain power, but I can do it. I'll manage. Last month I was where was I last month? Oh yeah, last month it was right before I was leaving on my boat trip. I was frantic that week. That was awful. This will be a lot more relaxing. So so I got 2 days to get all this stuff done, or 3 days to get all this stuff done, and then Monday's a holiday. But I'm not gonna punt it to the weekend. I'm gonna get it done. So that's gonna be my job, and you guys have a fabulous week, and we will do it again next week. All right, I appreciate it. Have a good day. Take care. Oh, don't forget Monday holiday. Yay.